Welcome to our video where we will explain the interpretation of the research trade ideas. I wish to stress that these examples are dated and should not be misconstrued as investment advice. This how-to serves to help the investor interpret the research trade ideas and are not to be seen as any recommendation of any kind. My name is Sarel Snyman and I'm joined today by a very smart young man, Gavin Leo Smith. Hi, Gavin.
Hi, Sarel.
Gavin is the team lead of our analysts here at PSG Wealth. I asked him to explain the trade notes they produce so that the normal investor like myself can interpret these trade ideas to make better informed investment decisions. These ideas help to get the investor to a place where they are managing their own diversified portfolio of stocks with a matter of success. At PSG Wealth, we follow a prudent approach to estimate the value of a stock. We realize that growth can also have considerable downside. A good investment should contain a built-in margin of safety. It is far easier for an investor and on their psyche when they avoid risk rather than having to recover from a big loss. So when you do these trade notes, Gavin, what do you consider?
So in short, we consider the valuations, the quality of the business, and confidence. The most important of these in our recommendation is the valuation, and then we apply tilts to companies that exhibit either high or low quality and or confidence. We try and estimate the intrinsic value of a share by using the PEG ratio and some other valuation techniques.
One of the techniques you apply, and you mentioned now, to arrive at your recommendation is the PEG ratio, which is basically the price-earnings ratio that's divided by the expected long-term growth rate. Can you highlight some of the benefits of the PEG ratio without going into the technicalities?
It basically uses readily available information to determine value. It's in an easy to comprehend format and gives an idea of expected relative return in the future. So we're not looking for a fair company at a great price, but rather looking for a great company at a fair price. Look, intrinsic value is almost impossible to calculate, but it's essential to estimate.
Now, when you guys look at the quality of a company, what are some of the things that you consider?
Well, firstly, companies may be cheap for a good reason. Poor quality businesses should trade at discounts to their competitors. So in this, we look at profitability, the quality of earnings, which compares how earnings translate to cash flows, operational efficiency, and then lastly, operational momentum. This uses several financial metrics, such as changes in working capital, shares in issue, financial leverage, to name a few. But given the unique nature of each business and industry, there are always exceptions to these measures. In an attempt to mitigate this, we look at these metrics over time. A good example is a credit retailer. If the company has strong sales in a particular year, which is a good outcome, we would expect that earnings would not be converted into cash. However, cash flows would occur over time as these accounts are paid off. If not, this could indicate that there's a rise in bad debts in the business.
Understand. I see your trade notes have a confidence ranking on it. What is that about?
So it's an attempt to quantify the forecast risks in the valuation. Here we look at the financial structure of the business, the stability of reported earnings, the risk of a dividend cut.
Dividend cuts is no good news for an investor. You know, we buy shares in order to share in the profits of those companies without having to rock up for work. The dividend's kind of our paycheck.
Yeah. Another item we look at here is the dispersion of consensus target prices. Let's say one analyst has a target price of 10 Rand, while another has a target price of 100 Rand on the same share. This indicates that there's quite a lot of uncertainty about the prospects for that business. Once we calculate these ratios, they're weighted to a mark out of 100. A higher value would indicate a higher confidence in our valuation.
Okay, understood. So confidence is a good thing, but it's important to remember that markets are sometimes volatile and can stay irrational longer than we could potentially stay solvent.
Yes, definitely. No valuation method is foolproof. Trading involves the risk of capital loss.
So to summarize, you consider value offered by using things like the PEG ratio, you assess the quality, calculate the confidence score. When you do a trade idea such as this, let's look at that portfolio guidance matrix. You depict those considerations in a picture that seems easy to understand and comprehend. How does it work?
So the triangle represents the three factors that inform our recommendation, and these are valuation, quality, and confidence, which we've just spoken about. The closer the triangle stretches to the outer edge of the green triangle, the better the scores are. So let's take the examples of MTN and Vodacom. In MTN, we see value and some quality, but low confidence. While Vodacom is high quality business, good confidence, but we don't see it. The share looks expensive.
Okay, so it would be ideal to buy a stock that stretches to all three of the edges, like the Tsogo Sun one.
Yes, so when they align, we'll typically assign a higher percentage allocation to our portfolios.
Speaking of those allocation percentages, what do they mean?
It's a suggested exposure to the specific share that we would recommend in a portfolio. So based on the three measures we've discussed, we will suggest an active weight in relation to the share's weight in the benchmark. So just looking at the notes here, a green header indicates that we would consider an overweight recommendation in the share, meaning a higher allocation to the share's current allocation in the benchmark. A red would indicate an underweight recommendation, while neutral would be, while grey would be neutral.
Okay, so it's fair to say that we can take an overweight position in a stock with a green percentage and to rather avoid any kind of position in something with a red, like the Vodacom on the right-hand side.
Yes, but I'd just like to reiterate that these notes are used as examples. They are dated, so the valuations and recommendations here may not necessarily be applicable.
Okay, so in conclusion, what can the client expect to get from these trade ideas?
Well, we aim to have a well-balanced portfolio of quality stocks at attractive valuations with below average financial risk. We have a higher confidence in the return potential of our portfolios based on this methodology.
Well, Gavin, thanks for giving us insight and helping us to understand this powerful tool. This will surely aid our clients to make more informed, well-researched decisions, which could potentially increase their portfolio returns.
My pleasure, Sarl.
Thanks, Gavin. So there you have it, a powerful tool from PSG Wealth that can aid you to manage your portfolio with success. Go to our YouTube channel to watch more how-tos that'll aid you on your investment journey, or contact us at wealth@psg.co.za or 0860 000 368.